Now, what I want to do with this video is introduce you to trading options. I'm going to start with the very basics. First thing I want to cover is what is an option contract? Why are they used? Why do we even have them in the stock market? And then we'll get a little bit more into the details in future videos. I want to start with the basics. A lot of people come up to me and say, Hugo, how can I start trading options? What is the best way for me to start? And the main thing that I tell them is you need to know two things to start trading options. Number one is what is a call? Number two, what is a put? Those are the two main things you need to familiarize yourself with. Once you know those two things in and out, then the rest of it is really building on that knowledge. How to sell a put, how to sell a call, how to get into a little bit more complicated strategies like a straddle or a credit spread. There's so many strategies with options, but they all start with the basis of calls and puts. So what I'm going to do today is kind of run you through what is that, what is a call, what is a put, and then what we'll do is we'll go ahead and buy a call, buy a put, and see how it reacts with the stock market today. Alright, so what is an option? Now keep in mind, options are an advanced form of trading when it comes to the market. You want to make sure that you are familiar with the basics and the fundamentals of the stock market, right? You want to know how to see or how to determine the health of a company. You need to familiarize yourself with ratios like price to earnings. You need to understand pretty much how to trade the market normally, right? Bid and ask prices and so on. Trading options. What are options? Options are what you call a derivative. It's a form of a derivative. A derivative is essentially a financial tool that is based on the underlying price of said stock, right? An option contract is essentially what it is, what it tells you it is. It's a contract that gives you an option, period, right? So let me give you a real life scenario as to how an option or why an option would be used.
All right, so using a real life example, let's say these are your townhomes, right? And you want to buy this corner townhome for $300,000. But they may build a parking garage in this empty lot, or they may leave it a beautiful park. If it's a garage, that house is going to be worth $150,000. If it's a park, that house is going to be worth $300,000. Nobody knows what's going to happen. So you offer the owner, I will propose a option with the option to buy your house for $270,000 in 6 months. And for that option, I will pay you $25,000 right now. So what happens? They build the parking garage. The house is now worth $150,000. So you tell the owner, I decline to exercise this contract. You lose the premium that you paid, so the $25,000 for that option, you lose that. So the seller of the house keeps it, right? But he's got a bigger issue, which is the house is now worth $150,000. Now let's say they build the park and the house is now worth $300,000. You go ahead and execute your contract, right? And you have now the option within those 6 months to buy that house for $270,000. Now your all in, however, is the $270,000 you're going to pay for the house and the $25,000 premium you already paid for the option. So all in, you're at $295,000. So that's still a better option than if you had bought it for the $300,000 up front without the certainty that it was going to be a park in front of it. And so that's the purpose of an option. It gives you the option but not the obligation. That is what a call is. That is also what a put is. They each give you exposure to the upside or the downside, depending on how you want to formulate that contract.
In the stock market, every stock has what you call an option chain. So the option chain is essentially the list of all the different strike prices of the stock, along with the price of what people are selling them for and what people are buying them for. And throughout the market, depending on the stock, you're going to find, and depending on the liquidity of the option chain, you're going to find spreads. So the spread is the difference between what people are willing to buy and people are willing to pay. You're going to find spreads that are very large, or you're going to find spreads that are very, very, very thin, right? Because the more important, or the more attention, the more volume that a stock has, the more efficient that market is, meaning the less gap there is between the bid and the ask. And so those are all fundamental concepts that you need to understand before you begin trading options, because that is going to determine a lot of your success. So now that we went through those examples, I want to do a quick trade here. We're going to go ahead and buy a call, or we're going to go ahead and buy a put. Okay? Now, buying options, I want to emphasize something here. Buying options, you are paying for that right because you are buying that option. Now, what I do and what this channel emphasizes on is the selling of options. The selling of options is you're on the other side of that transaction and you are collecting premium. You are collecting that fee for the options that you are writing, for the options that you are offering. Okay? So for this exercise, you're going to see that this is ultimately a debit. It's going to cost us money. And as we progress with this channel, eventually we're going to be getting credits for those options. What's up, option traders? This is Hugo with Living with Options. Please like this video and subscribe so I can continue making this content. Thank you. This was funded with $16,000 about 3 months ago. So if we were to do the 3-month year to date, we're up 88%. If we were to do the year, we're up 131%. So what do we want to do today? What we're going to do today is we're going to go ahead and buy a call, or we're going to go ahead and buy a put. Okay? Now, today is September 19th, so we have a very rough week ahead. Okay? We have the Fed announcement where they're going to go ahead and raise interest rates. It is still not clear if the Fed is going to raise it 75 basis points, 100 basis points. So the market right now is very volatile. We're also going to have home sale numbers. We're going to see if there's a decline in inventory, an increase in inventory. So there's a lot going on this week. So for that reason alone, what we're going to go ahead and do is we're going to go ahead and buy a put. So when you buy a call, you are betting that the market is going to go up. You are what they call being bullish. Right? Bullish as in a bull. You're a bull, you're going up. If you buy a put, it is because you are bearish and you are betting that the stock that you are buying the put option for is going to decline. Okay, so keeping that in mind, let's go ahead and do a stock that I think will have a very rough week. And again, it's already had a pretty rough morning. You know, it's 3:45, market's about to close, it's down 3.5%. You know, it hasn't really done much for the past month. It's got a high of 38. Right now we're at 33. If we look at the 3 months chart, you can see it's completely going sideways, which is good for option traders, right? When you're selling options. When you're buying options, you do want it to have a fairly large spike going down or up. And a sideways chart is generally good for a breakout, right? Which means that the stock, this right here, what you're looking at is essentially, and you have to look at the market in terms of what it is, right? The market is essentially a fight between sellers and buyers, right? So it is the people that are what they're willing to pay for it and what people are willing to sell their shares for, right? And so that is what determines the stock price. So when the stock is going sideways, it means you have a pretty clear balance between buyers and sellers, and so there isn't a much monumental movement when it comes to the stock. And when it does that for a fairly long time, usually one or the other starts to gain ground and you'll see the stock either go up or go down. Now, given the market conditions, given the interest rates, given how volatile the past couple months have been, we're going to go ahead and buy that put. So what you do here, I'm going to use Robinhood. The majority of my trades I do on TD, Ameritrade. I think the Thinkorswim software is amazing. I'm going to do a video getting into how I use the TD platform to do my more complex trades. But for now, we're going to use Robinhood. I think the interface is very clear. I think it's very upfront, and it helps a lot with those that are just starting. All right. So what do we have here? We have pretty much the Zillow stock, right? So it's telling us right here what the price of the stock is right now, what it's gone down today. Ignore this. This is one of my strategies that I'm trying out on my small account here. This key statistics is very important, right? And we'll get into a little bit of what these metrics mean, but essentially what it tells you is what's the 52-week low. So what's the lowest price it's reached in 52 weeks? What's the highest price it's reached in 52 weeks? So look how much Zillow has already gone down. It was at 104.05. That's the 52-week high. It's trading at 33, a 28 52-week low. So, you know, there's definitely, it's definitely already corrected a large amount. So let's go ahead and jump on that train, all right? Here it gives you some good news, some related news. Here it tells you what analysts are thinking. So they're telling everybody to just hold. Their earnings have been fairly consistent. It seems like they lost money on quarter 3 of 21, quarter 4 of 21, then they went back up. So let's go ahead and do it. So we go on the right-hand side, right? And this interface right here is if you just want to buy a share. But we're actually going to go right here where it says Trade Z Options, okay? And right here on the right, this is where we pick that expiration date. So this is where you pick up until when is that contract going to be active. And like I mentioned, some option chains, they have them all the way out to look January 2025. So you can buy an option that's valid all the way up to 2 years out, you know, which is great if you want to have long exposure, if you want to hedge your exposure to a certain market. That is why a lot of people use these types of derivative or option chains. So let's go ahead and do a short-term one just so that we can capture and ride the stock market wave of the news that's coming out this week. So we're going to go ahead and buy a put, okay? And you can see it's green because obviously a lot of people are expecting this sort of correction, and so the prices or the premium that you would be paying for those put options has gone up, right? It's gotten more expensive to partake in this bet. But regardless, let's go ahead and do it here, right? So right now it's telling us that the stock market is trading at the stock is trading at $33.03, right? So we're going to go ahead and buy a put. Now, the closer the put is to the strike price, right? So if we're at 35, if we're at 33.03 and you're buying a put of 33, well, you're generally going to be paying a little bit, they're going to be way more expensive, right? Than if you're buying, let's say, a 31 put, right? Because obviously it's going to be less risky for 33.02, which is the stock price, to cross the $33 strike price, right? So that's the price you're agreeing for the contract. It's less risky, or there's a higher probability of it crossing that than there is of it crossing a lower figure, right? So that is why generally they're a little bit more expensive. So look, as we're talking, Zillow is closing down. Now it's 350, so I'm going to go ahead and execute this trade as the market's about to close. Zillow's trading, hovering at around 33, so let's go ahead and buy a $32 put option, right? So real quick, 32, you see how our break even is 31.31? Because right now, it's telling us that the cost per share of buying this contract is 72 cents. Now, a key thing that I forgot to mention earlier in the video is that every option contract is 100 shares, period. That is the same all throughout. The break even is 31.90, which is pretty much your premium that you're paying plus the strike price, right? Because even if it crosses the 33, you already paid $1.12 or whatever the premium is. So that's why you have to add that to your break even, okay? Now here it tells you how much the stock needs to go down, right? And so let's go ahead and buy one. We're at $33. Let's go ahead and buy the 32, okay? And so we've clicked the 32 one here. 32 one is 71. This right here are called what we call the Greeks. The Greeks are pretty much the kind of like the details of how that option is expected to react to the market. And we'll get a little bit more of that into the details. You don't need to worry about that just yet. Here it tells you how much people are willing to pay, how much people are willing to buy it for. So that's our bid and our ask. And then it tells you our open interest or our volume. So there is a little bit of volume, 135. That's not too bad. So let's go ahead and purchase this one right here. So you click on it. It'll populate right here on the right. Long put. This right here kind of visualizes how that stock is going to perform, right? So it tells you this is where you start to kind of make money if it goes 31.29. Everything below 31.29 is all gravy. It's all it's all profit. If it doesn't go below that, then you can't exercise your option, and therefore you lose your premium, which is the $71, right? Max profit. Now the max profit is a little bit not that I don't want to say not true, but it's a little bit exaggerated because it assumes a zero. So let's assume the stock of Zillow goes to zero. That is what you would make as a maximum premium. Now your max loss is 71 because if it doesn't go below the $32, then you just lose the 71 you paid for that option of the contract, right? Let's say the stock rallies and the sales number and the Fed, everything comes out great and the market rallies. Cool, you just lost 71 bucks. That's it, all right? So let's go ahead and put in this trade. You click continue. Now I'm always a fan of putting a limit price on it. I don't really like to let the market just kind of determine, right? So it says that 71 is kind of what the last traded for. So let's see if we can get a 70 in there. Click review. Let's go ahead and submit. Got it, bang. Now, real quick, what I do want to show you here is pretty much a summary of what you are doing, right? So we click it here. You are paying $70 for the right to sell 100 shares of Zillow for $32 per share by September 23rd. If the Zillow shares aren't $32 or are lower on September 23rd, this option will expire worthless. All right, so we already went ahead and bought it. We go back to our main folder here, and we see it right here, Palantir call. I'm sorry, not Palantir. Zillow put, one buy. And so here it shows you kind of the value of the option itself. Okay, so you can see it's kind of lost a little bit of value. It kind of peaked in value at 1:45 p.m. It's 97 cents, $97 for that option. Here it gives you a little bit of the breakdown of everything we just discussed, what your average cost is, what what you're up or down on the actual put option, and what the market value is. Right? So this will hopefully increase as this decreases. That is the balance. Right? We sold that put yesterday, Monday, at basically 3:50 p.m. Right? So essentially it's been a total of maybe an hour and a half of market open, right? When you add up the 10 minutes from yesterday left in the market plus the hour we've done today, about an hour 10. Let's go ahead and revisit that put that we sold yesterday, right? So that $32 put that we sold, Zillow right now is currently down 2.22%. It's down on the anticipation of the home sales figures coming out tomorrow, as well as the Fed hike coming in tomorrow. Now, this is some strategy that I'm going to talk a little bit more in detail in future videos. But essentially, we have two options here, and two options that I would do, right? So as you can see, we bought it for 70 cents, and it's now worth 96 cents or $96. Remember, each option is 100 shares. It's a little package of 100 shares. So just right now, we are already up almost 40%, 37 to 40%, right? So that is a substantial gain, 40% in an hour of market. Pretty good returns, right? So what I would do right now is I would have two strategies, right? If I had, usually I stick to position sizes of around $5,000 to $10,000 per strategy, right? So what I would do in this point is the market generally overreacts to incoming news, right? So the market right now is very pessimistic on what's going to happen tomorrow. That is why it is falling. Now tomorrow we don't know what's going to happen. More than likely, the 75 basis points is already priced in to the market. That's why we had a very red market last week. So if the Fed does do a 75 basis points, more than likely we'll see a small rally in these stocks. Now remember, your contract expires on Friday, so you want to be very sensitive to these short-term movements. Now if the Fed does a 100 basis point hike, then this will probably continue to drop. But I don't want to bet my whole position on what's going to happen, because quite frankly no one knows what's going to happen. So what you do, and the strategy that I will talk a little bit more in detail, is sell a large portion of your position. So sell 75% of your puts for the Zillow for this particular strategy. Sell them right now. You lock in that 40% profit, which is astronomical for less than an hour of holding it. You gather 40%, and then you leave that remaining 25% to react to what happens tomorrow. And you either have two scenarios. It'll rally tomorrow and your put will expire worthless. Great, you just lost, whatever your premium was, the 70 cents per share. Or it drops significantly, and these options are going to print you money, and it's just going to add to your profit. Either way, you already locked in a profit, right? And that's the whole point. You want to lock in profits. Do not get greedy. And as you become a more sophisticated trader, you're going to have your own metrics. If the option gets to 75%, 50%, whatever the return metric is, take gains. All right?
All right, traders, that's it for today. I hope you learned the basics of option trading, how to buy a call, how to buy a put. Please subscribe, like this video. I will be putting more content out on what is next. Thanks.